Good morning and a warm welcome to you all. Welcome to a discussion about capital allowances and the budget impacts. I'm John Lovell, Managing Director of Lovell Consulting. I have a background of about 30 years practical experience in capital allowances. I'm a chartered quantity surveyor by background and also a tax specialist. I've worked here within an accounting firm, and Lovell Consulting has been established for 24 years. I will today be working based on my practical experience. I'm going to try to make this as practical as possible. And if any of you do have questions, please email through those questions. You can use this webinar format to ask live questions, or feel free to send emails afterwards. And what we tend to do is we anonymously provide responses to questions which we will email out to everyone. And if any of you require CPD certificates, please again just let us know from this webinar or separately by email. Now, there's a good number present now, so I'm going to make us start. So fresh from his success of Eat Out to Help Out, Rishi, Mr. Sunak, he has one of the main things he's done in the recent budget. We've termed it Splash Out to Help Out. And by that, he's trying to encourage companies to splash out on plant and equipment, machinery, with the hope that that will trigger substantial investment activity in the UK economy. And here we go. He's regarded in the office as something of a heartthrob. He's known quite widely as Dishy Rishi. All the girls in the office love him, and even the boys quite like him, as thanks to Rishi, they can now call themselves super capital allowances specialists. So the good news in the budget, and it wasn't all good, but let's start with the good news, is the introduction for the first time in the UK of 130% super capital allowances for general pool plant. So that's the first time there's been such a generous deduction. And in simplistic term, if you're a company and you invest 10 million in plants and equipment, then instead of that 10 million of allowances being spread over time, you will actually get 13 million of allowances, all available to be offset in the first year. So for companies that are spending a lot of cash, that meet the requirements, they will have super tax deductions in the first year, which they can either use in the current year, or if they've got losses, they can carry forwards and potentially carry back. And that super capital allowances applies just to general pool plant. And I'll be explaining what is included in that category of general pool. There's also a new 50% super capital allowances for integral features. That's things which typically have a longer life, things like air conditioning, lifts, heating in buildings. And the remaining 50%, you can still continue to write off, either using the 1 million annual investment allowance, which would give another 1 million tax deduction in the first year, or you can write off the 50% balance at a much slower rate of 6% on a depreciating basis. But it's great news for certain businesses. And the other very generous feature is before budget day, it was only possible in most situations to carry back tax losses 1 year. And you can now carry back unlimited tax losses in 1 year. and it's been extended to year 2 and 3. And in years 2 and 3, you can now carry back a maximum of 2 million tax losses in each of those years. The other very positive news was the introduction of 8 new free ports in the UK, which also have substantial tax benefits. And we will be going through what some of those benefits actually are. So this is coming to a substantial cost to the Treasury and ultimately taxpayers. The super capital allowances in the first few years is going to cost the Treasury 29 billion of tax revenues. That is a substantial cost to the Treasury, but the intention is, the stated intention is to get people, to companies in particular, to be investing in the UK economy. So splashing out now to help out the UK economy. This super allowance has a 2-year life, and thereafter it's anticipated that normal capital allowances will continue, but not so generous in terms of the extra allowances, the extra 30%, and the normal capital allowances are provided at a much slower rate. The loss carryback being extended to 3 years is a more modest cost. This is in millions, so it's about 1.5 billion cost in the first 3 years. At Lovell Consulting, we will be trying very hard to make that number as big as possible by helping companies make increased capital allowances in current years, which will then hopefully wipe out or reduce tax payments in earlier years. Now for some of the bad news. The really bad news is these super capital allowances will only apply to companies. So individuals are denied these super capital allowances, as are LLPs, as are conventional partnerships. A corporate member of an LLP is probably able to benefit, but we need to see more detailed legislation on that particular point. But if you can't benefit from the super capital allowances, you can still claim conventional capital allowances. And the really sad news is that property companies are excluded. So pretty much any trade of leasing of machinery and equipment is denied the super allowances. That's really quite harsh, given that the property industry has had a very tough year, given the rent moratoriums. But we do understand this was a Treasury policy decision. We thought initially it may have been a mistake, but it is actually a clear policy decision that they wanted to exclude property companies from benefiting from the new super allowances. So I hope you don't switch off at this point in disgust. If you're a property company, please do carry on listening, because conventional capital allowances are still possible to be claimed by propcos, and it's probably fair to say that conventional capital allowances have never been so generous. There may be a few instances where property companies may be able to benefit from the super capital allowances. Subject to seeing the details, we think that maybe it will be possible to benefit if a property company has a separate operating business that maybe operates serviced offices and is actually providing services. And if expenditure is incurred by the serviced office company, that may be eligible for the new super capital allowances. The other bad news is corporation tax rates, which have been on a declining path, currently at 19%, are expected and stated to increase to 25% in April 2023. I think the real message that the Chancellor was trying to make was, look, invest now, claim as many capital allowances as you can now, and create a tax shelter so that you can carry forward those allowances to mitigate against a potential higher 25% tax rate. And one of the other criticisms is these super capital allowances are super complex. They're quite tricky. They're not so straightforward. So there has been some negative commentary that they are too complicated. And be careful that if you've got individual assets like loose plant and equipment and you sell the equipment, you will get a clawback if you sell within a short period of some of the super capital allowances that have been claimed. And for companies that trading companies, such as predominantly operating businesses that are going to benefit, there is likely to be a clawback if they sell fixed plant machinery. There isn't any clear legislation on this point, and we have been in dialogue with HMRC Capital Allowances Policy. We expect there'll be some further guidance in terms of what happens when plant and machinery fixtures like air conditioning and the like is sold from a building. And the other bad news is the annual investment allowance, which is currently 1 million and was extended to the whole of this calendar year. That is stated that it will drop to just 200,000. So that will mean from 2023 onwards, the value of allowances in terms of the immediate allowances that you can claim will reduce. Albeit they'll have more value in another sense, that instead of being offset against corporation tax rates at 19%, they will be being set off against corporation tax at a 25% rate. So there's some very good news, but it's also, like always in pretty much any budget, there's also some correspondingly bad news. And I think the real shame for the property industry is in almost all situations, it's going to be denied these super capital allowances, which I think is a real kick in the teeth, given the pain that has been carried through this corona period by many small, medium and large propcos. And where does it all end up? The Sun newspaper did this very nice graphic. It's a picture of Wembley Stadium. It shows that the UK, the government total debt is in the order of 2.2 trillion. Now, I think for most of us, that's a number that we struggle to comprehend. So the Sun newspaper very helpfully piled up £50 notes to show just exactly how big that debt is and what it would look like if it was £50 notes piled up on top of each other. This is the problem that the UK is facing, along with many other countries around the world, that the corona period has exacerbated government debt. Now, how will governments try and pay for this going forwards? So in the UK, this is an extract from the budget, the Red Book. It's called the Red Book because it has a cover on it. If you're a tax specialist, it's called the Well-Read Book. If you're a politician, it's referred to as the Unread Book. Now, what this indicates that the total tax receipts by the UK Treasury are in the order of 740 billion. And corporation tax, it comes as a surprise to most people, is a relatively small proportion of that. So it's kind of less than 50 billion in most years, projected to understandably drop in 21-22 to 40 million. And one of the stated ways that the Chancellor is looking to recover some tax receipts is through the 25% higher corporation tax rate, which is showing that the tax receipts will almost double if that corporation tax is introduced. The much bigger tax, though, are the income tax, national insurance, which are huge in comparison to corporation tax receipts. And some skeptics have thought that Mr. Sunak may have wanted the negative criticism of his budget to be about higher corporation tax rates to disguise the freezing of personal allowances, which will have a much bigger tax impact. There are also people like myself who are quite skeptical. Will corporation tax actually in practice be increased straight from 19% to 25%? That's a huge jump. I'm a little bit skeptical. There will be a election sometime around 23, or I think the latest is 2024. Will the Conservatives really want to be fighting an election on the back of much higher corporation tax rates? What message does that send to the global economy about Britain? My guess is that Mr. Sunak will be hoping that the huge investment in capital allowances does actually happen and that the economy substantially picks up. And then in a year or 2 years' time, he can then say tax receipts are much better than expected, and we will phase in or even scrap this higher corporation tax rate. But who knows? He probably doesn't know himself. It all depends on what happens to the UK economy over the next 2 years. And as we mentioned, the actual revenue raised by corporation tax in the UK is relatively modest. I mean, 50 billion is a huge number, but in the context of 700 billion of overall tax receipts, it's a relatively modest amount. And if we do go to a 25% corporation tax rate, that will have a significant impact in terms of how we compare. We will move up to the red line. And if you see right at the bottom, Ireland has just a 12.5% corporation tax rate for trading businesses. It does, in fact, have a 25% rate for property investment companies. But it would make it very hard for, say, businesses in Northern Ireland paying tax at 25%, when just across the border, the tax rate would be exactly half of that. So that's another reason why I'm a little bit skeptical and hope that in practice the 25% rate doesn't actually happen. And here we can see on this graph, George Osborne was a big proponent of reducing corporation tax rates with the argument that lower tax rates stimulated investment and resulted in overall higher levels of tax. Philip Hammond broadly of the same view. And that's why, again, I think it'll be surprising if we see this huge step up by Mr. Sunak, particularly if by then, who knows, he could be Prime Minister or he may still be Chancellor. Now, just to put this in context, there's a very helpful, interesting website called Tax Watch UK. I've lifted some of this information from their website and modified it slightly. Very nice example looking at the potential impact on a business like Amazon UK. So if we look on the left-hand side of this slide, so Amazon in the UK has something like 3 billion of sales income in 2019. I would imagine that's stepped up very substantially post-corona. But as has been well documented, despite that huge turnover and relatively large profits, they pay very little in the way of corporation tax. So those tax numbers are purely corporation tax. Clearly, they pay huge amounts in payroll taxes and VAT and other taxes. But if we look purely at corporation tax, it's relatively modest. And what this slide shows that in 2019, they had expenditure on new plant and machinery of around 163 million. And I've calculated that very approximately, very crudely, that if all of that plant and machinery was on general pool plant, the capital allowances additions in the year would have been in the order of 29 million. So that would have sheltered 29 million of profits from taxation, other things being equal. But if we take the same numbers and assume that in 2021 to 23, they're going to spend similar amounts on plant and machinery, instead of getting a first year tax offset of 29 million, that will increase dramatically, even though based on the same expenditure, to 211 million. So I think what you can say reasonably confidently is a company like Amazon will benefit hugely from these allowances if they continue to invest, and it may encourage them to invest more. And that is the intention for the Treasury. They want people to say, look, this is a fantastic time to invest. Instead of getting just 29 million of tax losses, which means they could shelter 29 million of profits from tax, they can now shelter in the order of 200 million of profits from taxation. So politically, that might create a problem for Amazon because there's a lot of media attention on what they do or don't pay in corporation tax. On the right-hand side, you have the national grid, and the results are far more dramatic for the national grid. And they normally pay huge amounts of corporation tax. According to their accounts, of the order of 480 million of corporation tax that they pay in a typical year. Now, for them, they have huge capital expenditure. As you can imagine, in 2020, they spent 4.5 billion on plant and machinery. Now, for them, again, very simplistically, the allowances would have triggered a shelter of 824 million of allowances. They could have sheltered 824 million of profits from tax just using capital allowances. The super capital allowances will dramatically increase that to something in the order of 6 billion. So for the big companies in these kind of industries, the impact in the next 2 years will be quite dramatic. There's been various comments by politicians. Mr. Sunak, before the budget, his approach is to keep taxes low for people. It doesn't mention companies in this quote. So again, I think his intention will be for corporation tax to be as competitive as possible. The OBR criticised the super capital allowances, and they just thought that all it will do is bring forward investment that was already planned. I think it will actually trigger investment, but clearly you can only invest now if you've got the cash or the finance to do so. And for struggling businesses, that's going to be very difficult. Mr. Sunak does believe it will increase the amount of investment and make the UK a much more attractive place. Theresa May, she has criticised it. She's much more in favour of tax benefits for research and development. And what was interesting to me, I hadn't really picked up on this before, that apparently every year at budget time, the Treasury have been encouraging the politicians to make capital allowances more attractive. That's great news for me as capital allowances specialist. It's good news generally for businesses that within the Treasury, they do see improving capital allowances as making the UK more attractive. Now, let's do a simplistic comparison of what allowances you could benefit pre-budget and today. So pre-budget, we still had very generous 150% tax relief available for decontaminating land. So removing asbestos from buildings, provided you didn't put the asbestos in, then companies have been able to benefit from that very generous allowance. There's no change in last week's budget. And the 1 million of allowances that you can write off in the first year, you can write off more allowances over and above that, but the first million on any type of plant, you can write that off in the first year. That is still the same. The big change, though, is expenditure that you normally write off at quite a slow rate, at 18% each year. That's you can, if you're a company, get this 130% super deduction. Otherwise, if you're a property business, there's no change. Your situation is pretty much exactly the same, pre-budget, post-budget. And the same applies with 6% integral features, or what's referred to as special rate expenditure. If you're a company, you can get this generous 50% first year write-off with the balance spread over the remaining 6%. But again, if you're a propco, no real change. For repairs, no change. You can still get tax relief. The other big change was on free ports, which there are now special incentives for 8 free ports. And the change that we have mentioned is the 3-year carryback of tax losses, which previously was just 1 year. Now, the key points with the super capital allowances is it applies to contracts that have been signed on or after 3rd of March 21 by companies. I've got to keep emphasising that. And you may want to consider delaying purchases until after 1st of April 2021. There's a limited scope here for planning. There's anti-avoidance legislation, so you do need to be quite careful. And also the super capital allowances only apply to buying new plants and equipment. So if you buy second-hand plants and equipment, you just get normal capital allowances. HMRC, in the last few days, they have clarified that if a trading company such as a hotel was to buy a newly developed hotel that hadn't been used from a property developer, then they should be able to benefit from these super capital allowances. So it doesn't have to be totally new. So, situations where you're buying from developers for the first time, you may be able to benefit from these allowances, provided you're not buying in a property company. It would need to be bought by a trading business like a hotel company or a nursing home type company. Just to clarify that point, if you look at structure 1, where you've got a separate propco and an opco, the propco is denied these super allowances but can claim normal routine allowances. But most operating companies will be able to claim the super allowances. So if the operating company, say a nursing home business or a retailer, they should be able to get the new allowances. Conversely, in structure 2, if you've got a trading business, again, let's take a hotel company that maybe owns and operates the hotels or some of the hotels in that company, then it should be able to claim super capital allowances where it buys a new property or builds a new property, and the same if it fits out or refurbishes a building. I've now got some case studies just to put some numbers on this, where it's more kind of property, more typical property expenditure. So in this example, you might have a construction company, or it could be any trading business where they refurbish their offices. And in this example, they've spent 5 million, and we've assumed that 2 million is on general pool, things like petitions, carpet, IT, computers, and the special rate, things like air conditioning, lighting, of 1 million, and then the balance at the slow tax relief, the structures and buildings allowance. Now, the impact of the new super capital allowances where this applies is Post-budget, you'd get a first-year tax saving of nearly 600k, with a future benefit of 89k. Now, pre-budget, it would have been less than half of that in the first year. So the first year saving in this simple example would have been just around 258,000, and the allowances would have been pushed more into the future of the 311,000. So if this example, instead of being incurred by a trading company, it was incurred by, say, a property company or an individual or an LLP, the pre-budget calculation would be the applicable one. Another interesting example we modelled yesterday for one of our hotel clients who's thinking of spending 10 million. They're a hotel operating business and looking to refurbish a hotel. They meet pretty much all the requirements, and the works are not starting until after April this year. So in this example, they asked us to model what would be the impact pre-budget and post-budget. So pre-budget, the first year tax saving by claiming these allowances would have just been around 450,000. The impact of the super allowances is to increase the first year tax saving to 1.4 million. I appreciate the numbers a bit small maybe on these slides, particularly small if you're listening to this from a phone. We are quite happy to send you the slides so you can look at them full scale or print them out. But it's quite dramatic, the impacts, and clearly the bigger the expenditure, the bigger the impact of the super allowances. And it's such a shame, in my view, that the property industry have been denied this benefit. The free ports, there are 8 sites. They're spread over the UK, and I'm not going to read out the slides. You can look at this in your leisure. There are various tax benefits of constructing within a free port. Again, we think that propcos will be denied these allowances, and the benefits are targeted at operating companies. So, for instance, if Amazon was to construct a building in a free port and they were to incur the expenditure on constructing, say, a big box within a free port, they would benefit from these special allowances, and also potentially the super capital allowances. But we do need to see the legislation on that point. Conversely, if it was a propco building it for Amazon and leasing it to Amazon in a free port, the propco would be denied these new tax benefits, but the operating business, Amazon in that example, would be able to claim these benefits. So what they're doing is they're giving an enhanced 10% tax rate for the structures and buildings allowance. So basically the structures and buildings allowance are normally spread over 33 years. So the tax relief on the structures and buildings allowance will be much quicker. And for any plant and machinery of any type in the free port, there will be 100% first year write-off, and it's not capped. And it's important to say that there's no cap that you can claim on super capital allowances as well. So quite a tax advantage in terms of capital allowances. There are also some SDLT and business rate benefits from citing your business in the free port. But again, really quite harshly, propcos are being denied. Now, just to be clear, what do we mean by general pool? This is where the 130% super capital allowance is. It's on expenditure mainly targeted at fittings, furniture and equipment, IT, large, heavy type equipment. But in a building context, it does also include building-related furniture, fittings and equipment, things like sanitary ware, carpet tiles, fire alarms, telephones, and sprinklers fall in this category. So if you are a company and you're carrying on a trade, like a retailer or you're a law firm set up as a company and your trade is providing legal services, you should be entitled to super capital allowances on these type of assets at 130%. I've referred a few times to special rate or integral features. Normally, the tax relief on these assets is provided really quite slowly. It's most of the things that you associate with buildings, things like lifts, heating, lighting, hot and cold water, solar shading. And again, if you're a company and you're carrying on a trade, then you may be able to benefit on these type of assets from the 50% super capital allowances. So I'm now going to run through how with conventional allowances or with super capital allowances, how you can mitigate tax and in a lot of cases get cash refunds. This last 12 months has been difficult for most businesses and cash flow has been critically important. And we've been doing a lot of work helping individuals and companies claiming conventional capital allowances to try to get cash repayments in current periods or going back at least 1 year, sometimes 2 years. And we've got a few case studies now that will illustrate how pretty much any individual, any company can benefit from the normal pre-budget capital allowances to get repayments or at worst deferral of future tax. So in this example, it was a leisure business. They'd had particularly tough corona period because they'd had to completely close down and they're really struggling for current cash flow. But prior to corona, they'd had very successful trading and they had paid corporation tax to actually written out a check to HMRC for $500,000. And they'd only claimed very obvious capital allowances. So their accountant had claimed allowances where invoices were very clear, but they'd missed about 4 million of allowances for plants and equipment that was not segregated within the invoices. And we as a firm made our own assessments. We looked at the building costs. We visited the project to identify an extra 4 million of allowances. Now, the great news for the company was they were able to amend a tax return. By amending the tax return, they were able to claim these allowances and were able to get an actual cash repayment from HMRC of around £300,000, which substantially helped that business. And this same opportunity is available to pretty much everyone, that if you've spent money on buildings, buying buildings, fitting out, refurbishing buildings, there's a very good chance that not all of the allowances will have been claimed. We find that pretty much half of individuals and companies do still not get the allowances to which they are entitled. And these savings, as I say, they apply to individuals, LLPs, corporates, any tax-paying industry, entity, including property businesses. Another example, again, very recent, we had a property developer client that had done a large-scale residential scheme. And despite having Big Four accountants as their advisors, they had not claimed any tax relief for decontaminating the land. And it had been quite badly contaminated, this land. And we suspect the reason that no tax relief was claimed was because the building invoices just said things like substructures, building works, excavation, earthworks. It was not obvious to the accountants looking at the invoices that there had been any decontamination. However, from a seminar just like this, a property person picked up on the point, spoke to their clients and said, look, are you aware that there is special tax relief even on a residential site? for decontamination. We got appointed. We identified 14 million of decontamination expenditure. This particular client had a tax loss, so they were, in this example, able to surrender the loss for a cash repayment from HMRC, and they got 3 million back from HMRC that had previously been missed. So it's always worth revisiting prior projects. There's no real time limits. There's confusion over time limits in this context. Provided you still own an asset, you can normally make increased claims to capital allowances in current or open tax returns. There are some time limits for claiming specific reliefs. For land remediation, there's a normal 4-year time limit. You can sometimes extend that. But if you've got clients or yourselves have spent money buying, fitting out, constructing buildings, and you still own them or they're still being used by you, there is the opportunity to make additional claims in current years. Another example, again quite recent in the Corona period, a private family had created a new private school. It had previously been an office building, and they refurbished it to convert it to a school. Now, they hadn't claimed any allowances on the purchase, of which we were able to get allowances on some of the 10 million. I think we got allowances of 2 million on the purchase, and on the refurbishment, pretty much all of it qualified for different types of allowances. So we were able to identify an extra 4.5 million of allowances, and they had previously paid corporation tax on account, and they were able to get an immediate tax refund of 400,000, and they now have increased capital allowances that they can carry forwards. Now, the great news about the budget is, in this example, instead of going back and recovering tax paid in just 1 year, they could probably, depending on the timing, go back over 3 years. So there's a lot of work to be done predominantly by capital allowances specialists to help companies and individuals to benefit from getting repayments of tax that they've previously paid, and then they'll be in a position to continue trading successfully. You might be thinking, well, yeah, this all sounds very simple, very obvious. My accountants will be doing this routinely. They may be if they're working closely with capital allowances specialists. If the accountants are trying to do it themselves, they will definitely be claiming capital allowances on obvious things, but the chances are they will be missing a lot of allowances. And this example will hopefully explain why. So if someone buys a building, it may be, in this example, they bought it from a non-taxpayer, they paid 5 million for it. It may be that there's no tax election in the contract, very little information. And an accountant would just see a purchase document with nothing in about allowances, and they may claim nothing. Whereas a specialist can check the entitlement, value the allowances, visit the building, and on something like an office, there could be allowances up to 1/3 of the price. So for that reason, a lot of allowances get missed. And the same applies when you've got building contracts. If there's invoices that say things like alarm, fire alarm, and it's obvious, then the accountant will claim those allowances. But otherwise, if the invoices just say building works, very often a lot of allowances are missed. So for those two reasons, there's normally scope to get more allowances. A specialist can visit buildings, segregate costs, do detailed reports, which can be filed with the tax return. Now, this is routine tax planning. It's not tax avoidance. It's not evasion. It's something that if you can prove that allowances were not fully claimed, you can justify then claiming extra allowances in current or open periods and using potentially the 3-year carryback. Who can benefit from allowances is taxpayers. So charities, pension funds, the non-profit sector typically can't benefit. Some local authorities, though, that have been investing in commercial properties, they have set up companies. So even a local authority, if they've set up a tax-paying company, they will be able to benefit from these kind of allowances. Who can benefit from allowances generally? I'm not going to read this out. I'm going to focus today more on the super capital allowances column. It's only really occupiers that can claim the new super capital allowance, but propcos can claim pretty much every allowance. Property developers not entitled to claim capital allowances or super capital allowances, but they can benefit from decontamination of land. How do you make capital allowances efficient? My advice is think about it early. We try to train our clients to think about capital allowances in offer letters, heads of terms, ideally. Keep it short and simple in heads of terms. Work behind the scenes with the property lawyers, have slightly more complex, more clear wording in the purchase contract. And it can be very advantageous to have a capital allowances specialist working in the background, helping your property lawyers to figure out whether allowances are material or not to a transaction. In some cases, allowances will be very material. In other cases, they'll be immaterial. And it's very helpful to the property lawyers if they know how hard to push with certain questions and certain wording in the contract. And I would also advise some caution here for property lawyers and accountants. A lot of clients will put the burden on their accountants and on their lawyers and say, well, look, you know everything about capital allowances, get it right. It's a tricky area because it involves a lot of practical knowledge about buildings and about dealing with the valuation office and HMRC. So if you are pushed into that corner and you're a property lawyer or a tax advisor, I would suggest you try and limit your responsibility with some wording a little bit like this on your report on title, and just advise your clients, look, this is a specialist area, get some specialist advice. Now, there's a golden scenario for if you're buying a property. The kind of golden scenario is if you're buying where the former owners have been non-taxpayers. So in this example, first owner was a property developer, not entitled to claim allowances. Then went to a pension fund, again, not entitled to claim allowances. Now, in this example, because no one has previously been entitled to capital allowances, the new buyer will get a lot of allowances. And on something like an office or a hotel, could be 30 to 40% of the purchase price available for plant and machinery. They may even be able to claim some of the structures and buildings allowances. So this really is a golden scenario. A lot of accountants would not claim anything because in this example, purchase contract would be silent. There would be no capital allowances tax elections. What I've referred to as a silver scenario is where maybe the first owner was a property developer. They've then sold it to a taxpayer, in this example in 2007. The owner then was quite well advised. They've claimed allowances of $1 million. They've protected that $1 million by putting in a £1 tax election as part of the purchase contract. So what that means is the seller has kept allowances of $1 million, and most accountants, most property lawyers will say, buyer, I'm very sorry, but you've only got £1 worth of allowances. A capital allowances specialist can look at this transaction and not in all cases, but in quite a lot of situations, get more allowances without disturbing that tax election. And the reason for that is if the former owner owned it before 2008, they probably were not able to claim allowances for general pool, cold water, or solar shading. So straight away, the new buyer, without disturbing that election, can attribute value to the price that they've paid to those unclaimed assets. There are other ways as well, but I won't go into them in detail in this seminar. Happy to explain them separately. So don't always assume that a low tax election means that there are no more allowances. There may be none available, but in a lot of cases there are. A little example here, these three heroes, global heroes. So imagine that you have the great fortune to advise HRH Woke, and she wants some clear advice on capital allowances. And one of the things you have to do as a specialist is look back to see what the capital allowances history is. And you'd probably find out that Sleepy Joe hadn't claimed any allowances, and Desperate Don, he'd claimed allowances of maybe 20 million. And if you're the property lawyer or the accountant, you're going to be asked by your client what allowances are available to me. Now, it's probably likely in this scenario that Donald kept his 20 million of allowances and just gave Joe just a £1 tax election. And that may be why Joe hasn't claimed anything. So does this mean that Megan gets nothing? Now, a lot of people would assume from these facts that Megan would get nothing. However, straight away, we know that Donald spent the money in 2006, so he wouldn't have been able to claim integral features for general lighting, cold water, solar shading. So straight away, there are unclaimed assets for those expenditures. And we probably need to persuade Joe to claim or pool those assets, some wording in the purchase contract to transfer those value across to Megan. And on something like this, it could be 10% of the 100 million. There could be 10 million of extra allowances available to Megan. We also probably know that Joe didn't like Donald's gold fittings, ripped them all out, and Joe has therefore spent some money himself. Maybe he hasn't got round to claiming those allowances. So again, there's potential allowances for Megan to benefit from. And Megan herself, once she's bought this building, she'll probably put lots of lovely green fittings, and she will be entitled to further allowances on her expenditure. So without going into too much detail, what this slide does illustrate is you need to very carefully look back at the entitlement, figure out who's spent what, and have some clear wording in purchase contracts to persuade sellers to claim or pool allowances and transfer them across to buyers. It does vary from each transaction. There's not a 100% established pattern with every property. It depends quite a lot on whether the seller is a tax-paying entity or a non-tax-paying entity. But a capital allowances specialist working with your lawyers can help make sure you get a favourable as a result as possible. Another case study here, someone bought an industrial building, relatively recent, and even on quite modest expenditure, the allowances now can be quite generous. So on a 1.4 million purchase, this was bought from a developer, the allowances on pretty much everything except for the land, and the same with the fit out expenditure. So if you're buying a building that's come from a developer or from a pension fund or a non-taxpayer, the allowances can be very substantial. And if this was being bought after April, same fact pattern, and it was being bought by a trading business, maybe a wholesaler or a distribution company, they could potentially, in this same example, benefit from the new super capital allowances. Structures and buildings allowance, you can read this at your leisure. They're based on the balance of expenditure. It's spread for most buildings over 33 years. When it first was introduced back at the end of 2018, it was spread over 50 years. So it had a very slow life previously. There are some downsides to claiming the structures and buildings allowance. Pretty much all capital allowances for fixed plant and machinery, you will not pay any more capital gains tax when you sell. You can keep the benefits that you've had against profits as well. But for this relatively new structures and buildings allowance, you do have to recognise in the capital gains computation what structures and buildings have been claimed. So I'm not a huge fan of this. I'm happy to go into this allowance in more detail, maybe in another seminar. There are lots of misconceptions about capital allowances. I've previously mentioned there's confusion over time limits, but generally speaking, if you still own or you still use a property asset, you can make additional claims in current tax returns, and you may be able to get actual cash back from HMRC of tax you've already paid. And so it's seldom too late. It can be if you've sold an asset. So it may be too late if you sold an asset more than a year ago. And as we alluded, claiming normal capital allowances for plants and machinery will not result in a higher capital gains charge. And it's very advantageous now, in most cases, for non-resident landlords to start claiming capital allowances. If they have excess capital allowances in an SPV, they may be able to reduce the CGT. And in fairness, that applies to onshore companies and offshore. There's very little difference now in tax terms for offshore companies, as they pretty much all fall within the UK corporation tax regime. Now, the big thing we hear a lot is our tax advisors are dealing with this. And that's partly true. All tax advisors will claim the routine capital allowances. But I think what we've demonstrated in these examples is the more complicated stuff, which can be the largest chunk of expenditure, is often overlooked because the details are not nicely provided for your accountants. And it's only really where you're working with capital allowances specialists that you will get full value of the allowances. And as we've mentioned, looking back in time can help to reduce your future tax bills, your current one, and carrying back. And the combination now of unclaimed capital allowances and the 3-year carryback has made capital allowances very potent. Also, I'm not going to read this out. You can look at it in your leisure. But the kind of priority now for segregating expenditure is firstly, allocate where you can to the 150% tax relief. That's the most generous. Repairs can be very an immediate year one tax write-off. If you're entitled and you're a company, then obviously claim the 130% super allowance and the 50% and the annual investment allowance. And then last of all, the kind of expenditure that you get no tax relief on is things like land and stamp duty and planning fees. So very important that you carefully segregate expenditure to get the fastest tax relief first. Otherwise, if you just claim the 3% structural buildings allowance, you're only going to get tax relief over 33 years. Whereas, if you can get it all in year one or most of it in year one, that's hugely advantageous. We're seeing some kind of post-corona impacts. One thing that we're seeing substantially is landlords have a lot more empty space. They're having to strip out vacant floors and improve communal areas in particular to help with the marketing of their buildings, make them more attractive. So there has been quite a lot of expenditure from landlords. So do remember you can claim capital allowances. There can sometimes be interactions with dilapidations expenditure as well. And we are seeing a lot more in the way of landlord capital contributions. They substantially higher for obvious reasons. You can, if you're a landlord and tax-paying landlord, claim capital allowances on your contribution, it's important to consider in the agreement to lease who's going to get what allowances. And that's become particularly more important if the operating business can benefit from the 130% super allowances. So there's going to be a little bit of tension. Clearly, the landlords can't benefit from the 130%, but a trading company will be able to. So there needs to be very careful drafting in agreements to lease where there are capital contributions. I've kind of highlighted the obvious missed opportunities. I'm not criticizing property lawyers, and I'm not criticizing tax accountants. They do the best they possibly can. They all work very hard generally. It largely comes down to the information that they're provided. And property lawyers very often are not given nice information by the sellers. The CPSEs on a property purchase can be very unhelpful. They can be struck out. They just say not applicable or not known or information already been provided. I had one of those this morning and the information has not been provided clearly. So I have huge sympathy for the professionals. They all do, in general, try to get the best capital allowances result they can. But if they're given poor records, poor information, that's tricky. And that's where a capital allowances specialist can very often help unravel things, simplify things, and ask the relevant questions. And a lot of advisors will, as a result of that poor information, accept low capital allowances figures and not look to see if there's more allowances, like in the Megan example, that can be claimed. So a lot of scope, and particularly if you've got bought buildings which have mixed ownership structures, so maybe half of it was owned in a pension fund and there's a tax election from the tax-paying half, well, that tax election is only binding on the tax-paying half, and you will be able to claim more allowances over and above from the allowances that have been transferred by the pension fund. How we can help, I'm not going to go through that. You've got that slide to look at in your own leisure. So I've now concluded what I wanted to talk in the webinar. There have been a few questions. Clearly, I'm going to answer the easy ones, and I'll give the hard questions as follow-up for my much smarter colleagues to respond. So one of the questions is, does plant and machinery expenditure eligible for the super deduction go into the main pool? That's a good question. HMRC have indicated they're going to update the capital allowances manual. I suspect it does, unless they're going to create a super pool. I haven't seen anything in the guidance or the legislation, so my instinct would be to say it will go into the normal main pool. Having said that, you will have to consider what happens when there is a disposal, and they've indicated that they want to see a balancing charge that does not go in the pools, which is shown separately in the tax computation. So my instinct is saying it probably does go in the main pool, but let's wait and see what the guidance says. Someone's asked if slides and the recording can be sent to all of you. Yes, absolutely. We can send them to anyone that requests them. We normally send them to people who haven't been able to attend. And good news is we've had about 250 people listening to most of this webinar. Can you use the annual investment allowance on the remaining 50% of expenditure in the special rate pool? Yes, we believe that you can. So what you'd want to do, you'd get 50% that you can write off in the first year. The other 50% would be written off at just 6% on a depreciating balance. We understand that you can allocate an unused AIA to the balance of the integral features. What kind of someone's asked, what kind of properties can you claim allowances on? Hotel owner occupiers, yes, you can. Care home operators, yes, they should be able to benefit from either normal capital allowances or super capital allowances. But as I mentioned, just be a little bit careful if the propco has been in a separate business and leased to the operating business. You need to be careful with those structures. Someone's asked if you can claim capital allowances on houses in multiple occupation. It's quite difficult with HMOs. In tax terms, they're regarded as dwellings. You can claim repairs to HMOs. If there are if you've got a block of, say, HMOs, and there's a communal area, a shared communal area shared with everyone, you should be able to claim plant and machinery in a shared communal area, but not a shared communal area within an individual HMO, if that makes sense. And the capital allowances legislation is a lot more generous with respect to service departments. So in most cases, service departments are not regarded as dwellings for capital allowances purposes. We've come to the end of most of the questions. I would like to thank you all for listening. And if any of you have follow-up questions, feel free to email them through to us. And thank you all very much for your time.